We'll start with this tariff issue that the US has put forth in front of the world. It's already put it on EU. Japan is angry. Mexico and Canada are also pissed off. And there is an equal chance that India might also be in the same basket as other countries. How do you see this situation globally with so much of tariffs put in by America on the rest of the world?
Well, since April 2nd, when you've had the Trump tariffs and what we call the Great Reset internally, I'm actually in Miami, not too far from where President Trump has his wonderful retreat. Sadly, I'm not invited to the retreats. So, but I can say this is that clearly what we have seen since April 2nd is a complete reset of how the world thinks about trade and of how the world will think about investments also. On the trade side, there's very little anyone can predict. No one has an idea of what the next tweet, what the next post is going to be like, and what the impact of that will be on trade policy. But what one can say is that given the uncertainty that is emanating from the United States, there will be a relook at how one should be allocating assets globally. The one thing investors hate is uncertainty. That's what they hate. They detest uncertainty. When we last spoke in October 2023, interest rates had just started to increase, and people were unsure of where interest rates were likely to be. And we now know that interest rates are going to remain high. So investors have adjusted to the certainty of higher interest rates. And in between 2022 and the last year, 2024, they were unsure where rates were going to be, and they hated uncertainty. So it's not that markets cannot readjust to a fact. Markets do readjust to facts. But what they hate is uncertainty. Whether Mr. Powell, who's now on screen, will remain as a Fed chair, what will happen to, sort of trade policy. They hate that sort of uncertainty. So we are living in uncertainty, and investors are going to react to allocations based on uncertainty, in our opinion.
Okay. Mr. Dayal, in all this uncertainty that you very rightly point out, there are two things which are clear. Investors have expectations, and advisors and fund managers and equity strategists such as you have to deploy money, whether we like it or not. The fact remains that nobody pays an advisor to be in cash. Now, against this backdrop, how do you allocate money to assets? In the same time frame that you mentioned, gold has gone up by about 50-55%. Silver has doubled, at least in India. So, are smart investors getting defensive?
So I'll correct a few things that you said. At least in the quantum world, we do many times advise people on the international side, our international clients, not only that we will keep cash in our portfolio because of uncertainty, but we actually suggest, very unusual for a fund manager, to take money off the table. If we find we have something called an upside potential indicator for our flagship value fund, and in that we can estimate, and we've got 231 months, nearly 20 years of track record of estimating the NAV of our fund likely to be 2 years in the future. All right. And of course, it comes with all the caveats and everything else that you can talk about in a disclosure. And using that as a profit guide, if you will, of how much money you can make by being invested with us, we actually guide allocations into equity markets, if you will. So I'd like to clarify that we do get paid for holding cash, because when we hold cash in extremely uncertain times, you're potentially preserving capital. And of course, you take advantage of it when you can, like a time of COVID or time of Lehman going back years ago. But in terms of the allocation, at Quantum Mutual Fund, we built something called 12-20-80, 12-20-80. And the 12-20-80 was really an outcome of our experience over the years, as individuals. And it came into full force after Lehman and certainly after COVID, where we felt that every investor must have something in cash, what some people commonly refer to as emergency funds. And we call that 12 months of your expenses. What if you spend 1 lakh a month, then keep 12 lakhs really safe. And the other balance, so if you got a crore, 12 lakhs is safe. The other 88 lakhs, you are actually moving into a 20/80 allocation that's happening out there. And that 20% goes to gold and 80% goes to equity. So we've been recommending gold for many, many, many years.
If you like the video, do like, comment, share, and subscribe.